Morning, everybody, and let me thank KDI for organizing the conference with us and for having our paper on the program. This is co-authored with Paolo Mauro, who you just saw, and with Olivier Blanchard. When I was in graduate school, I was told that every good presentation starts with a chart. And here is a chart in terms of background for this paper, and is a chart of the Great Moderation. So in the roughly 25 years preceding the crisis, we had witnessed a compression in output volatility that was also accompanied by very low inflation. This was quite marked in advanced economies, but you see that the trend was also visible in emerging markets and developing countries. So partly because of this, many people were convinced that we thought how to run macroeconomic policy, and that we knew how to run macroeconomic policy, and we knew how to deal with cyclical fluctuations. And overall, this established a macro consensus that went more or less like this. Inflation was the main and sometimes sole target of monetary policy, and the policy rate was its instrument. Stable inflation meant a stable output gap, and not much else mattered from a cyclical point of view. Fiscal policy was seen as having only a secondary role for cyclical management. And definitely financial regulation was seen as completely outside the macro framework. A little caveat, these views were held more religiously in academia than in policymaking circles, but nevertheless they did affect policy and institution design in a major manner. So in a roadmap for today, the crisis is forcing us to reconsider this consensus. And in this paper, we do exactly that. And we first review what we thought we knew. Then we'll look at which elements the crisis has proven wrong, and we'll take a first pass at how to reform it. So let me start from the pre-crisis consensus. As I said, monetary policy was supposed to look primarily at inflation, sometimes only at inflation. And this was well grounded in macroeconomic theory, in particular in a standard neo-Keynesian model. Stable inflation meant a zero output gap, and this was the best possible thing that policy could deliver to the economy given the imperfections present. There was also reputational needs of central bankers, in particular because of the experience with inflation in the 70s. And so inflation was also supposed to be very low. Most central banks in advanced economies would target around 2%. The risks of such low inflation rates were considered small in a world with small shocks, in the sense that the probability of falling into a liquidity trap or in deflationary spirals was considered very small. Again, in policy circles, this was taken with some flexibility, and many countries practice flexible inflation targeting. For example, and so the inflation was targeted over the medium run, and allowances were made for shocks like oil shocks, as long as core inflation expectations remain anchored. In some emerging markets, there was also attention to exchange rate levels and volatility, but this was also done in a way with the public communication that really what mattered was just the inflation rate. As I said, there was one instrument for this one goal, the policy rate, and this relied on a couple of important assumptions. One was that monetary policy really affected the economy not through monetary aggregates, but through asset prices. And that all interest rates and asset prices were linked through well-established arbitrage conditions. So one only needed to affect one rate to affect the entire system, and this was best done through predictable and transparent rules. A corollary of this view is that the structure of intermediation had only minor effects. There were exceptions made for the credit channel, for example, because of the liquidity transformation function of commercial banks, but more or less the consensus focused on a direct instrument for a direct goal. On the limited role for fiscal policy as a cyclical stabilizer, well, the automatic stabilizer were seen as okay, but there was widespread skepticism about discretionary measures. One reason was, well, if monetary policy could do it all, there was no need for a second lever. And in advanced economies, the primary goal was to reduce high-level of debt to GDP ratios. In emerging markets, limited bond markets constrain the ability of fiscal policy to act as a cyclical stabilizer. And more importantly, there were lags in design and implementation of discretionary measures that would prevent fiscal policy to act at the right time, so measures would always come too late, but by the time the recession was over. In certain conditions, there were also risks of distortions caused by the political process. There was again some disconnect between academia and policy, and if you read any IMF staff report from an Article 4 consultation in the past few years, you always find a paragraph about the appropriateness of the fiscal stance. And by that, implicitly you recognize that there is some role. De facto, there was a role for fiscal measures. I think an important tenet of the pre-crisis consensus was that financial regulation is not a cyclical tool, and that macro dimensions of this were largely ignored. In particular, prudential regulation focused on the soundness of individual institutions, and it was aimed at correcting market failure stemming from either asymmetric information, limited liability, implicit or explicit government guarantees often associated with deposit insurance. In emerging markets, there was some attention to the macro role of prudential regulation, especially with limits on currency mismatches and foreign currency loans. But even there was sort of a no-no rule on the cyclical use of these policies. And intervening on the market was seen as mingling with market forces, and little thought was given to how these ratios could change over the cycle. Spain and Colombia were an exception in recent years, where they introduced so-called dynamic provisioning. All this, as I said, was backed by the Great Moderation, and there was some ambiguity as to the sources of the Great Moderation, so there were various views. One view was that we were just lucky and there were small shocks, and that's why we had a Great Moderation. A second one, they were based on structural changes, in particular improved inventory management and the trade integration of China and India, as we listened in part in the previous presentation. But there is fairly robust evidence that at least some role was played by improved monetary policy, in particular the anchoring of expectations. And this is shown in the way most advanced economists reacted in a different way to the oil shock, the recent oil shock vis-a-vis what happened in the 70s. There were also successful response to financial scares, in particular LTCM and then the bursting of the tech bubble, that convinced us further that monetary policy was well equipped to deal with asset price busts. So where we were wrong, at least this is an exploration in where we were wrong. The main point, I think, in the paper is that imbalances and vulnerabilities can brew under the surface of seemingly tranquil macro conditions. So let me show you a second chart. This is core CPI inflation and the output gap in advanced economies and in the rest of the world, particularly Euro area, the US, and before the crisis. And you can see that this was well within the norm of what you would expect it to be in tranquil macro conditions. Yet, house prices were growing at a reckless pace in many places, and this caused an increase in the vulnerability of households' balance sheet. Here we are charting on one side the credit to GDP growth on one side, and the change in the quick ratio, that is the ratio of liabilities to liquid assets for the household sector. And you see there was a major increase, and not surprisingly, some of the places where at the extreme of these are the ones that are suffering the most during the crisis, like Ireland, Greece, Spain. Let me go back. Oops. Okay. So we need to understand better the relationship between inflation and macro growth. In particular, we have little understanding of what happens during deflationary spirals. And what we believe is that the composition of output and demand may also matter for macro stability. So we are beyond just having low inflation and a small output gap. We need to look deeper. The crisis also underscore a problem with the so-called benign neglect view of how to deal with bubbles. It is very costly and painful to deal with a bubble after it bursts, and so we need to think about and reconsider this view and think about what to do before it happens. And the point that actually this is more controversial and made the papers is that low inflation limited the scope of monetary policy in facing a recession, in the sense that some central banks quickly hit the zero nominal bound, and there was consequently higher burden on fiscal stimulus. A second point is that discretionary fiscal policy is part of the arsenal of policymakers. In this crisis was obviously used because we ran out of monetary ammunition, and also because the recession was expected to be very long. So fiscal lags matter much less. But what the crisis remarks is the importance of having fiscal space, as we saw in the previous sessions, as countries that were more constrained by high debt before the crisis were much less able to face the recession once the crisis hit. And also, the crisis showed that the drawbacks with discretionary fiscal policies are still there, and especially even in the US, you see that it took over a year of recession to approve the stimulus package, and even after it was approved, it's been very slowly rolled out. Another point is that structure of intermediation does matter, and when a shock can force large players out of a market, prices can differ from fundamentals in a big way. And to some extent, wholesale lending is not very different from demand deposits from this point of view. And one reading of the crisis is that this was a run on banks, but a run on wholesale lending rather than a run on individual deposits. When this happens, arbitrage conditions are broken, and so the policy rate is no longer sufficient for policy making. An intervention in various forms through the acceptance of different kinds of collateral or direct purchase of assets can help in affecting the yields on those assets for a given policy rate. So was the great moderation just a fluke? Were we just lucky? Well, our reading is that no. Our reading is that we were lucky in the fact that the shocks that we faced were shocks that we knew how to deal with. And the other shocks that we didn't know how to deal with were more rare. And one way to read this, to read the problems in Japan in dealing with the burst of the 1980s bubble is exactly this. Monetary policy knew how to deal with shocks like the oil shock, but much less knew how to deal with shocks related to asset price booms. There is also a view, and I think this is a legitimate view, that sees the Great Moderation as partly a cause of the crisis, in the sense that both policymakers and market participants grew complacent and decided that their risks were not really there, and so took too much risk on one side and too much deregulation on the other. So this is looking ahead, and of course looking ahead is much more difficult than looking backward. Although, they joke about the difference between economists and meteorologists is that at least a meteorologist can tell you what happened yesterday. In our case, that's a puzzle too. But anyway, so we cannot throw the baby out with the bathwater, and many elements of the consensus remain valid. So we still believe that output and inflation stability are the main targets of policy. And of course, there is no long-term trade-off between inflation and unemployment. And to remark on what Jose mentioned before, central bank independence and credibility remains critical. And fiscal sustainability is of the essence, but some elements need rethinking. So let's see what we have decided so far. For monetary policy, we identified, I think, two main questions, if I had to summarize the paper. The first question is, given now we know that large, bad, big shocks happen, should we consider having slightly higher inflation rates ex ante, so to have more room for monetary policy easing ex post? Now, on the good side of this is that probably distortions in moving inflation rates slightly higher, still in the low single digits, would be small. on the bad side of these two problems, first, there could be changes in the structure of the economy, such as indexation, and in that case, the evaluation of those costs would be very different. And second, for central banks that already put a lot of stock in establishing a credible target at 2%, it may be very difficult to move to slightly higher targets. But still, we need to discuss this and look at serious cost-benefit analysis in the long run. The second question is the role of monetary policy in financial stability and how to deal with asset price booms and busts. We take the view that the monetary policy rate is a very poor and imprecise tool to deal with these misalignments. One question that was asked at some point is, would you put 2 million people out of a job because your banks are too levered or because your house prices are growing too fast? So we need much more targeted tools that could be used to deal with this kind of misalignments on specific markets. And for that, we also need better coordination between prudential policy and monetary policy. We also think that the crisis has shown that liquidity should be provided more broadly to market participants. In particular, we now know that non-deposit-taking institutions can be of systemic importance, and the runs on these institutions are similar to bank runs, so the consequence of that is that we need to broaden the safety net beyond commercial banks. Of course, this has to go hand in hand with the broadening of the regulatory perimeter, and one important challenge looking ahead for that will be that of a flexible perimeter that regulators can use to bring in within the regulatory umbrella new animals that evolve and become systemic over time, against the need for predictable rules and the certainty of the law. And where and how to strike this balance is a serious challenge. There is, of course, and the paper really pushes this, a macro role for prudential regulation. And for that, prudential regulation has to look at the system rather than just individual institutions. We could focus on capital ratios, loan-to-value ratios, loss provisioning that change over the cycle. For that, we need to build a buffer in good times. And that these changes could be triggered by variables not at the individual bank level, but rather at the systemic level. For example, good candidates are credit growth or the aggregate leverage. And these measures could be updated on a regular, almost semi-automatic basis in a very similar manner to what we do with monetary policy. So who should be the macroprudential regulator? Well, our view is that the central bank is ideally positioned to do that. First, there are problems in coordinating the action of multiple agents. The problems with Northern Rock after its market failure were a clear example of that. And also the implications of monetary policy of these regulatory ratios varying over the cycle call for putting the macroprudential regulator within the central bank. Of course, again, there is a trade-off, and if we give central banks multiple targets and possibly a less transparent objective function, accountability and credibility issues will have to be resolved. So in terms of critical cyclical role for fiscal policy, 2 points emerged from the crisis. One has been debated at length in the previous session, and the importance of establishing new fiscal room and bring down the high debt ratios. So I'll skip on that. But we also point out that it would be important to improve automatic stabilizer. In particular, we would like to see stabilizers that are very well targeted and do not necessarily increase the size of the government. For example, you could have tax credit to low-income households that are triggered by a certain level of unemployment. So in concluding, so I think I'll stay within my 20 minutes. The chair has not yelled at me yet. Many elements of the pre-crisis consensus still hold and remain valid. In particular, low inflation and stable output gap are a prerequisite for financial and macroeconomic stability, but they are not sufficient conditions anymore. And low deficit and fiscal room are needed more than before. We need to reconsider a few things. Zero nominal bound is a reality, and so we need to discuss how low an inflation rate is low enough. We need to improve automatic stabilizer for a greater role of fiscal as a cyclical tool. Most importantly, on the financial front, we need new tools. We need a better coordination between monetary and regulatory policy, a broader provision of liquidity, and a macro dimension of prudential regulation. And a point that we don't touch in this paper, but that is complement to this, we need to address the cyclicality of micro regulation. Thank you.